This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. Welcome to Bazaar Morning Call. This morning we are live from the Motilal Oswal studio right here in Mumbai. I'm Sonia Shanoy, and joining me as always Nigel and Surbi as well. Folks, today is really heavy. Lots of earnings, so much data, and we're bang in the middle of the week. How's the Josh?
Well, Josh needs to be high, right? And we're going to be starting IT earnings as well today, Sonia.
Yeah.
So think about Rima. Think about Rima, the way she's going to be battling in the evening, and we'll get through the day.
How's her Josh, I wonder?
Sky high.
But lots to talk about. I think for the global markets, the Josh has been pretty good because we've had, some rock-solid data that has come in overnight. And we'll talk about that. For our own markets as well, it's not been too bad, honestly. Yesterday, it was a bit volatile. We came off from the day's highs. But what we managed to do yesterday was hold on to that 19,400 mark. So the summary is that the uptrend for this market is still very much intact. The buy on dips is very much intact. Just a little bit of volatility and so much data flow over the next couple of days will decide the trajectory for the market. As I said, there was a surge in global markets overnight. The Dow did pretty well, actually. It was almost a 320-point gain. For our own markets as well, the flows overall are a bit mixed, but the FI flows have been solid. So yesterday, there was about 1,200 crores of buying from foreign investors. And in July so far, almost 11,000 crores has come in. Now, if you look at a couple of things to watch, as Nigel was mentioning, today is going to be really data heavy. You have the earnings coming through from the IT pack, HCL Tech and TCS today evening. For TCS, it's expected to be the slowest June quarter in a decade. So there's hardly any revenue growth and the margins are expected to fall this time. But the big question is a lot of this already in the price? Because for TCS as well, if you look at it, the stock is already down about 10% from the highs that it hit in the month of February. It has been lackluster. In the last 1 year, it's barely gone from 3,000 to about 3,270 or so. So is the bad news in the price? That's the question that we're asking. We won't have to wait too long to find out. And then, of course, you have the CPI reading from the US that comes out later today. In any case, 92% of the CME's Fed Watch Tool poll, people who they've polled indicate that perhaps there could be another Fed rate hike in the July policy. So I think the market is bracing themselves for that as well. But all in all, I think the bulls have sort of tightened their grip on the market a little bit. Let's see how it goes from here.
Sonia, I completely take your point, and it's good to be the optimist that we did hold above the 19,400 mark. Allow me to be the slight pessimist over here. It's always a bull and a bear that makes the market, right? Not really a bear, but I was noticing the fact that the market has failed to hold above 19,500 in the last 2 to 3 sessions. So the zone of 19,500 to 19,520, it's a very minor resistance of sort. I mean, nothing much to, I think, worry about. And Nigel will talk more about how the options sort of, tally stacking up around some of these critical levels. But the fact is that this is something which has been a mini challenge for the bulls, but no problems in the broader market. And that's giving us a different indicator. The kind of momentum we're seeing in mid caps, the buying, whether it was defense stocks or these EMS stocks yesterday, that's really telling you where the money is. And the money has been flowing in. We've seen the mutual fund flows, small cap funds, really raking in the moolah, mid cap funds. That's where the money is coming in. And it's this part of the market that's really on fire. Now, in terms of the data today, I call it a bit of a, test day for the bulls. Because the first test comes in the form of inflation, not just US inflation, India inflation as well. We'll get our CPI numbers today. The estimate is we'll still be around the 4.5% handle. However, the watch point is food inflation. And the sense is that the kind of declining trend that we're getting on food inflation, that might be arrested. We all have seen the headlines and we've all gone to the grocer, right? We know what's happening with those tomato prices. So I think food inflation will be a little bit of a watch point when you're talking about India CPI today. In addition, I'll just run the US numbers as well in terms of the expectation, because that's the major agenda setting in terms of the global market framework. The US CPI expectation is a 0.3% increase month on month and a 3.1% increase year on year. And as Sonia is pointing out, anyway, the market's kind of baked in at least one rate hike in the June meet itself. One more facet, when we're talking inflation, look at crude oil prices. Very quietly but silently, this Brent has moved to the $80 a mark. And this is a 2-month high for Brent. The dollars are a 2-month low, but Brent is getting at $80. So that's something that, perhaps one can't ignore, especially when you're talking about the inflation narrative. On IT earnings, Well, of course, we're talking about a very, very flattish quarter, no doubt about that. And this is, I mean, the numbers are as flat as it can be. 0.2% constant currency growth for TCS, 0.3% for HCL Tech, and a margin decline, a bigger margin decline on TCS because they did a wage hike this quarter. So that's the expectation that the market is going with. Now the positioning on these stocks. Since the bottom, and the bottom was made when we got the Infosys numbers, so since April, it was, I think April 19th was the day, since that point, how much have the stocks rallied? TCS about 7.5%, but the bigger rally happened in HCL Tech, 15%. However, in the last 3-4 sessions, HCL Tech has come off very, very sharply as well. There's been about a 4-5% decline on the stock already. So net, maybe you can argue that the market is going in, not very heavy, obviously. However, the stocks did run. We are not at 52-week lows for these stocks, so we have to, bear that in mind. But I guess as long as there is no joker coming out of the hat and there's no some big nasty surprise about very negative commentary, I think the market will be able to perhaps digest and move on because we've moved higher regardless of IT.
And it's interesting, this time this is the first time I think HCL Tech numbers are coming before Infosys, right? So the commentary from the management is something that could set the tone as well.
Yeah, so IT either it'll be in a phase of consolidation or maybe you could see a bit of a downtake. So you can't really rely on IT to fight for the bulls I'm talking about. But today what's going to be important is the Nifty Financial Services Index as well as the Nifty Bank. And yesterday, the reason that we ended virtually at the lower end of the range is because the Nifty Financial Services Index, well, it played out expiry. So from around 2:45, 3 p.m. odd, you did see that the Nifty Financial Services Index move lower. And that's what pulled the Nifty as well lower. A screen should come up for you on that front. But otherwise, yesterday was actually a good trading session because the Nifty Financial Services Index, well, that ended lower. But the mid-cap and the small-cap indices, well, there was green out there, and there was bright green. Small-cap index, I think, was up close to 100%, and the mid-cap index as well was up 0.8%. So portfolios would actually be feeling good yesterday, despite that little bit of a jitter that we saw in the final hour of trade. The key to track, or the big question today will be, can the financial stocks and the Nifty, bank stocks, can they reverse yesterday's expiry-related move? Because that's what the bulls will be tracking. And if we need to bounce, then it has to come in from the financials as well as the banking names. Given that we have IT earnings that are coming in and a bit of a whispers, maybe it'll be a rather tepid set of numbers that will come out. The FIs, well, they didn't do much on the index futures yesterday. And they continue to remain net long with close to 72% of their positioning on the long side. On the option side, two strikes I'll highlight. 19,500 call. There appears there is some writing out there. The premium from around 70 rupees, it ended at around 35 rupees odd. So there is a sense that there is writing out there. But at lower levels as well, there was some action at around the 19,400 put, which brings us to the level. Just plugging in both those two premiums. Well, on the downside, 19,360 becomes extremely crucial support. And on the upside, there is resistance being seen at around 19,540. And in the last two sessions, last three sessions, we have gone a couple of times above the 19,500 odd mark, but we can't hold on to those levels. Those are the recent highs that we're looking at. On the Nifty Bank, well, maybe we're 1% away from very, very crucial support zones. The 20 DMA as well as the 50 DMA, both of them, very, very crucial support zones is what we're looking at on both of them. 44,300 odd, that's a crucial level on the Nifty Bank that you should keep an eye out on. The GIFT Nifty suggesting a flattish start. Let's see whether or not the Nifty Bank as well as the Nifty Financial Services Index can bounce back.
Okay, but the important thing is there's still some green on the GIFT Nifty, so not too bad at least, I guess, as we start things off. Well, let's tell you what's lined up on the first half of the show today. We get you updates from markets across the globe. Jahangir Aziz of JP Morgan joins in to talk about the global setup, given that it's all about inflation and the next round of central bank meetings. Of course, our research team also brings you the CNBC-TV18 list of top 10 stocks to watch out for the day. At around 8:30 a.m., we will do a fundamental stock analysis with Devin Choksi, talk about some of the movers and shakers that are in the news today.
All right, very quickly, let's kickstart the show. We have plenty of opinion coming through. And first up on the equities front, Vikas Jain of CLSA says that the sentiment reading as per the CLSA India Bull Bear Index has jumped from 9% to 92% bullish as the Nifty has rallied 15% in less than 4 months. However, another 5 to 10% up move is possible if the Nifty extends to bull case valuations. Now, the difficulty in picking the top of any rally has led them to gradually scale down the risk as sentiment has extended to an extremely bullish point. they have booked an outperformance in DLF and HCL Tech. They've added back Infosys to the India portfolio. Interesting. CLSA also likes banks, insurance and energy, and they are underweight consumption and IT. Interesting. They are underweight IT, but they've added
Infosys. That's an interesting positioning from CLSA. Well, let's get to the money market action as well on the rupee. Kunal Sodhani of Shinhan Bank says dollar index dropped for the fourth consecutive day to below 101.5. That is the lowest in 2 months, while 100.85 remains the technical support for the DXY. The US 10-year Treasury yield cooled off as CPI data is due today, and it may provide more clarity about interest rate guidance. The dollar-Chinese yuan pair also cooled off. For the rupee, Kunal sees 82.15 as a support, while 82.55 could be the resistance for the day.
Okay, and on the bonds, Neeraj Gambhir of Axis Bank says that the domestic bond yields initially moved higher, tracking a rise in US Treasury yields on the hawkish FOMC minutes, but retraced after good demand in auction and short covering in the benchmark bond. Now, for the rest of the week, the market would assess the India and US CPI data and the auction demand. He expects the 10-year benchmark bond yield to trade in a range of 7.05 to 7.17%.
Well, we have a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. For the time being, let's run you through the list. We're looking at ITC, Lupin, Tatva Chintan. We have HOEC, Prestige Estates, PVR Inox, as well as Havells. All of them on the back of positive news flow. On the flip side, Delta Corp, Bazaar, and Happiest Minds will be reacting to the negative news flow, as well as the GST changes that we saw late last evening.
Okay, so all those stocks on our radar today, but let's kickstart the show with a view on the macros. Jahangir Aziz, Head Emerging Markets, Economic Research and Commodities at JP Morgan is with us. Jahangir, good morning. Always great having you on the show. And we are talking to you on inflation day, right? Inflation print in the US, inflation print in the India. That's the buzzword, really. I guess markets have, gotten used to the idea of at least one more rate hike in the US. But how are you looking at the inflation trajectory, and what should we be geared up for?
So we do have one more rate hike, which is the July rate hike. And I think that, the data will tell us, whether or not we get a September rate hike. And there's
Oops. I think this
economy that has shown remarkable resilience in the market that we've seen some remarkable resilience. Obviously, on inflation down, today's numbers, modest number will be critical points. But I think that by and large, we are getting to a point, the world is sort of getting divided into two parts. You have
Jahangir, unfortunately, we have you on a bad line. We'll just try and reconnect with Jahangir to figure out. But I think the point that he was making is that one more rate hike is sort of something that even JP Morgan is penciling in. We need to see what happens further down in September. But I guess, if we do get a print along these expected lines, it's no longer a shock, because if you look at the US market, Sonia, I think the middle of June is when US markets have started flattening out, even the NASDAQ for that matter. And the flattening out tells us the pricing in of the expectations that, hey, central banks, including the Fed, aren't exactly done yet. In fact, some commentators are talking about a divergence. They're saying Asian central banks may start actually cutting rates. Some of the banks like in Korea, India's way down that sort of, ladder of rate cuts, but some of the other markets in Asia, whereas maybe the West is not done and they need to still tweak on the upside once or twice.
No, I think what Jahangir, the point he was making is that this rate hike is confirmed by most are expecting it, but going forward, it's very data dependent, right? Yeah. So let's get to know what the inflation data is, and then perhaps we'll find out. But give and take everything, it's been such a great rally that the markets have had. The S&P 500 is up, it's substantially this year.
Yeah.
So I guess some flattening out won't really harm anyone, some consolidation, similar to what we've seen in our own markets as well. Let's do one thing. We'll try and resume that conversation with Jahangir Aziz in just a bit. For now, we'll take a quick break. We'll also get our entire research team to join in to help us, just identify all the big stocks of the day and how you should be positioned as we kickstart a new day of trade. Okay, welcome back to Bazaar Morning Call. Plenty of stocks to talk about. Actually, Nazara Tech will be one stock that everyone's going to look at this morning. As we know from the GST Council meet outcome, casinos, racecourses and online gaming will be taxed at 28%. But there's some commentary coming from Nazara Tech saying that this will apply only to skill-based gaming segment of the business and not to the entire business. So let's do one thing. Let's find out exactly what the impact of this would be. Mangalam is joining in. He's tracking both Nazara Tech as well as Delta Corp on the back of this. Mangalam, over to you.
Well, this is a negative surprise coming in for all these players. In fact, the GST Council has gone ahead and recommended casino, horse racing and online gaming to be taxed at a uniform rate of 28%. And for, casinos, tax will be applicable on the face value of the chips purchased in case of casinos. And for online gaming, tax will be applicable on the full value of the bets placed. The important part is here for, Delta Corp analysts believe that tax on face value of chips purchase may impact chip sales value at entry itself. So that would be a bit of an inhibition for people to go ahead and buy at 28% higher than the face value of chips that they're looking at. And secondly, tax on full value of bets placed in case of online gaming may treat game of skill at par with game of chance. So, that would mean that, the advantage that game of skill had would go away. Nazara Tech on its part has said that game of skill accounted for just about 5.2% of their FY23 revenues. So this will not impact their business as much. But going forward, remember, real money gaming was the top draw for all these players and was also among the fastest growing ones. And for Delta Corp as well, the trigger was the Adda 52 IPO coming in. So if this happens and this were to impact their business, then that could impact the valuations as well. So see a negative for both Delta Corp as well as Nazara Tech today.
Okay, got that, Mangalam. So we need to watch out for both of these stocks and see that explanation offered by Nazara if that kind of, cuts ice with investors. But let's talk about things a little more positive. We have, a mildly positive news coming in on ITC.
That's correct. Mildly positive news coming in on ITC. And the positive news is that the board has approved Sanjeev Puri's reappointment with effect from July 22nd, 2024. His term was to end next year, but he has been reappointed as MD and chairman by the board. This is now on the agenda for the annual general meeting. The shareholders' approval is awaited, and he will be reappointed for the next 5 years. Well, this wasn't really a question. The point is that stability at the top, at least for the next 6 years, gives people some comfort, especially after the run that ITC has seen and the next steps that people will be watching out for them.
Okay, all right. Mangalam, thanks a lot for that. Well, let's hop across to Abhishek. He's here to tell us about Happiest Minds. Morning, Abhishek.
Morning, Nigel. So sources tell CNBC-TV18 that Happiest Mind has launched a QIP of rupees 400 crore, which can be increased to up to rupees 500 crores in terms of the total issue size. So indicative price is around 924 per share, which is at a discount of more than 7% to yesterday's closing price on NSE. And SEBI floor price is around 972 rupees per share, which is at a discount of 5% to the indicative price that Happiest Mind has set. So just an alert, company has an approval to raise about 1400 crore worth of capital. As of FY23, cash on balance sheet was around 730 crore. Company has an aspiration of being a $1 billion revenue by 2031. So M&A is a critical part in terms of this revenue guidance that they have. Back to you.
Okay, thanks a lot for that. So we'll watch out for Happiest Minds. But Lupin is also on our radar this morning. Ekta's joining in to tell us why we should be tracking that one. Ekta, morning.
Morning. Well, definitely positive news which came out for Lupin last evening, close to the end of market hours. So we could see some follow-on buying. One of their units, which has a warning letter, has been cleared by the US FDA. So they have received an establishment inspection report from the US FDA for their Pithampur Unit 2 manufacturing facility, which has had a warning letter since 2017. This inspection or re-inspection was conducted in March and had received 10 observations. So the company has managed to actually clear those 10 observations successfully. And now the warning letter, as per protocol, should be lifted. We haven't had a clear direction from the company, but it is assumed to do so since it is an EIR with a voluntary action indicated status. So that means that the company has managed to clear a couple of their facilities such as Goa, Pithampur Unit 2, as well as the Somerset facility from the regulatory scanner in the past 2 to 3 years. So definitely a positive for Lupin. We could see some follow-on buying today.
Okay, we'll watch out for that, Ekta. Thank you very much. Let's get to Sonal then. She's watching out for a bunch of stocks as well this morning. Sonal, tell us more.
Well, 3 stocks on my radar. Let me start with Tattva Chintan Pharma because the company is looking to raise 200 crore rupees. This is via equity-linked instruments, so it will include a lot of securities here. Remember, the company recently bought a land parcel for 20 crore rupees where they will be doing a capex of around 300 crore rupees. Of course, we'll need more details here, but could be for the capex plans of the company as well. HOEC is in focus because subsidiary has acquired the balance 50% shares of Jionpro Petroleum Limited, and after this, it will increase the participating interest in the Kharsang oil field to 35%, and they will be now the operator of the field as well. There is an ET report on Prestige Estates. Prestige, remember, has been expanding in the Mumbai market. This report suggests that they have acquired South Mumbai land for 704 crore rupees. This is from DB Realty's subsidiary Marine Drive Hospitality and Realty. The deal values the plot at over 306 crore per acre, making it one of the most expensive deals in the real estate market in South Mumbai. So that stock will be in focus as well.
Okay, thanks a lot for that. So, Prestige Estates moving into the Mumbai market in a big way. We'll try and get more details on that. But PVR Inox has been in focus ever since that 5% GST was announced on food in cinemas. But there's some clarification that has come through, and we understand now that there is no financial impact on PVR. They were in any case charging that money. But Surbhi, can you clarify for us? And also, you're looking at Havels this morning?
That's right. So first on PVR Inox, now the GST Council has clarified that the GST rate on food items and beverages will be at 5%. Earlier there was some ambiguity on whether it is 5% or 18%, but now the clarification has come in that it will be at 5%. PVR was already booking the F&B at 5% GST rate. The company was in the view that F&B sold in cinemas is similar to that of restaurants, where it is 5%. Elara has a view on that. They said that there is no financial impact on PVR, but it is still positive news because it saves time and effort for the exhibitors in fighting the litigations against the state. Havels is also on my radar because there is an ET report that suggests that the company is going to venture into the EMS, which is electronic manufacturing space for ACs and washing machines. Now, on a pilot basis, company has already started manufacturing and product designing for ACs, but this is largely for global brands that caters into the Middle East and the US market. The company will not, they don't want to compete with their existing brand Lloyd in India. The revenue target from the EMS space would be 1,000 crores. Capex for up till now that has been spent on manufacturing facilities is 900 crores, and the current capacity that the company has for AC is 2 million units, and for washing machine is close to 7 lakh units.
Okay, all right. Thanks a lot for that, Surbhi. Well, here's a quick recap of all the stocks we just covered for you. Let's run you through the list of positive stocks. First, the stocks with positive news flow. They include ITC, Lupin, Tattva Chintan Pharma, HOEC, Prestige Estates, PVR Inox, as well as Havels. While stocks with negative news flow, as we mentioned, Delta Corp, Nazara Tech, and Happiest Minds.
Okay, all right. Well, that's our top 10 list. But now let's go back and reconnect with Jahangir. Hopefully, we have him on a better line now. Jahangir, back to you and that question on inflation. We were discussing first the expected US print and the fact that the market, at least I think, is geared up for one more rate hike, at least of 25 basis points. Your thoughts?
So we have the same view that, at the baseline is that there's at least one rate hike in the pipeline, which is the July one. But then, given the resilience of the US economy and the continued resilience of the labor market, let's see what happens tomorrow. But, if you get a 0.3, 0.4 core inflation print, that doesn't really put you into a comfort zone and rule out further rate hikes. And I'm using further rate hikes in the plural. So I think we have to wait and see. But, so far, the Fed has essentially delivered more rate hikes than the market had envisaged. And I think we might be in that state for some more months down the road. I think, on the inflation front, it is no longer that concern that we once had that, inflation was, at least core inflation was getting really, really sticky and, it could move up. I think there is much more comfort on that front. And I'm guessing one has to thank China for it because finally, the reopening normalization that one had been expecting a long time back is finally filtering through Chinese disinflation, through export prices. But I think that broadly, that's where I think things stand, that there is more comfort on the growth front, which obviously is not that great news for rate hikes, but there is at the same time more comfort that inflation may not, spike back up.
So that's on the US markets, right, Jahangir? What about back home? Because here inflation is shooting up, food prices, pulses prices have gone up quite a bit. And that has actually dampened hopes of a rate cut anytime soon. How are you feeling about what the rate trajectory could be from the RBI over the next 3 to 6 months?
So on the inflation front, clearly the food inflation is the problem, and then there are also concerns about, El Nino and others, which, I think those fears are probably exaggerated given the food stocks and food management. But I think India, too, is going to benefit from the disinflation that is coming out of China. I think we are underestimating that. So if you look at export prices coming out of China, which is essentially non-energy export, it is currently running at -7. Add to that the fact that the CNY INR has appreciated almost about 8-9%, and chances are that in the coming months, INR is going to appreciate further against CNY. And given the fact that China is our largest source of imports of non-energy imports, I think on the goods disinflation front, I think that disinflation will be imported. So whereas on one hand, 2 months back, we were all concerned about the stickiness of core. I think there is relief on the stickiness of core, but food inflation, it's anyone's guess, how things are going to pan out. But on the rate cut front, we have a rate cut. We have had the rate cut almost for 3 months now. The rate cut is in the fourth quarter, but it's not based on inflation falling off the cliff. It is actually based on growth slowing much more than what market consensus and possibly what RBI has.
All right. Hi, Mr. Aziz. Good to hear your thoughts. So what kind of growth estimates are you factoring in now for the coming year for the Indian economy?
So we're looking at about 5 to 5.5, but it's a first half, second half story. So I think the first half is going to be fine, right? And India, along with other emerging markets like China, has shown that resilience, and I think that resilience goes through into the first half of this fiscal year, which is the third quarter of the calendar. I think once third quarter gets past, I think there is significant amount of slowdown on the global economy. In fact, we need that slowdown to take place if, core inflation has to, globally at least, has to go to where, central banks' tolerance levels are. But if that slowdown does take place, I think, given the fact that India's growth over the last few quarters has been driven primarily by surprisingly strong goods and services exports, I think that's the driver that is going to get affected. And that's the reason why we expect in the second half of fiscal year growth slowing down in the 4.5 handle.
Okay. So Jahangir, I guess, what you're saying is pretty much in sync with the report that I was reading yesterday about this divergence of central bank actions. I think it was from one of your peer banks, Nomura, if I remember correctly. And like you're saying, that you're expecting one more hike, at least in the US, and penciling in a cut maybe towards the fourth quarter, end of the current year here in India. And I think there's more anticipation that maybe China will cut a little more aggressively. There's a lot of anticipation on South Korea cutting. So if we do get into that zone where Asian central banks are cutting and the West is not yet done hiking, what does that typically mean for fund flows? I mean, when has this divergence played out in the past? And, where should we expect money to head in such a scenario then in the coming months?
I think the divergence has played out several times. If you recall, going back to when Janet Yellen started a rate hiking cycle post 2017-18, we had exactly the same divergence. So if you think about what's happened over the last 2 months, the two-year US has moved up 120 odd basis points. And the 10-year has moved up 75, 80 basis points. Emerging market has not even reacted to it. And whether it's capital flows you're talking about, or whether it's portfolio flows, I'm saying that whether it's debt flows or equity flows, emerging market flows just haven't reacted to it. Neither has emerging market pricing of rate cuts or of bond yields have reacted to it at all. And this is after 120 basis points of increase in the front end of the US curve. And I think the key remains what it was back then during Janet Yellen's rate hike cycle. And the key is, again, the same thing, is what happens to the dollar. Emerging markets do not move just because there's rate differential widening or narrowing, as the case may be. Emerging market capital flows moves if growth differentials narrow or widen, and what happens to the dollar. Because the dollar has remained so steady, I think you haven't seen the kind of negative impact one would have seen if you truly had, if the front end of the curve had moved about 120 odd basis points and the dollar had actually strengthened on the basis of it. And I think that's where I think everything rests. I think you can go through US hiking another 2 or even more rate hikes and emerging markets cutting, whether it's Asia or Latin America, most likely in Latin America. But all of that is premised on whether or not the dollar holds at these levels, or even if it appreciates, it's a mild appreciation. If there is a disruptive appreciation of the dollar, then emerging markets get disrupted.
All right, Jahangir, well, a lot of things are data dependent, right? But at least for now, we know that in the next meeting, the US will be hiking rates. So that seems to be the consensus view. So we'll take it at that. Thanks for joining us and speaking to CNBC TV18. Appreciate your thoughts. That is JP Morgan. But let's move on. Plenty of stocks in focus today. A lot of brokerage notes as well. Sonal is here to tell us what she's looking at this morning. Sonal, over to you.
Good morning, Sonia. Well, some downgrades coming through, especially in the consumption space, and that is by Citi. Citi has double downgraded Pidilite to a sell from a buy. The target is cut to 2,200 from 2,800 rupees a share. They downgrade on the premise that FY24 estimates are already baked into the price, and current valuations look unsustainable as well at 70 times. Citi has downgraded Titan to a neutral from a buy as well, target at 3,280 rupees. Downgrade is on the back of a recent rally that we've seen in the stock price. They see limited scope for re-rating from here on. Jefferies is written on utilities because there's been a lot of chatter around smart meters. They say the Power Ministry has approved 205 million smart meter installations. GIC has announced a tie-up with Genus Power, which is talking about rising competition. Analysis shows a 1% impact on profits for Power Grid in FY25, and assuming a 10% share, they are also seeing a 2% impact for Tata Power and 5 to 8% for JSW Energy and Adani Transmission as well. Jefferies is written on Shree Cement, where they have a hold rating with target price of 22,250 per share. They say capacity expansion program to reach beyond 80 million tons per annum will be fast-tracked, and company is expecting another year of strong demand as well. So all these stocks on our radar today.
Okay, all right, got that. Sonal, thanks very much. We'll watch out for this list. Take a quick break on that note. On the other side, we'll be joined by Devin Choksi of KR Choksi, and we'll talk about some fundamental market ideas. Later, we also get into a conversation with Kulwin Shira, Executive Director at GNA Axles, to discuss the impact of the heavy flooding that we've seen in northern India. Stay tuned.
Welcome back. Hope you're having a good morning. The gift nifty is suggesting it could be a more or less flattish to a mildly positive start, but there'll be plenty of stocks that we're looking at. So let's discuss a few of them. We just ran you through the list with our research team. Devin Chokshi joins us to help us out with some analysis on the same. Well, Devin, before we talk about all the top stocks that we discussed, what about HDFC Limited? Well, in the current scheme of things, or in the current form, it's the last day that HDFC Limited will be traded. There could be some bit of a rejig, because we'll see the Nifty Bank, well, the constitution of HDFC Bank will go up because the HDFC Limited will come into HDFC Bank. How do you approach these heavyweights from here on?
Hi, Nigel. Good morning. As the weight rebalancing would be the requirement hereafter because of the merged entity. So obviously, we expect the amount of money to flow into the HDFC Bank, of course. But along with HDFC Bank, I think other index weights are also going to get adjusted. And that is where probably you're likely to see participation of banks like even IndusInd Bank along with HDFC Bank. As far as I think the higher amount of allocation of money goes into these two counters. That might cause some amount of disruptions to existing players like Axis, like ICICI, to a certain extent, where I think some amount of outflow may take place out of this counter. But considering the fact that this matter is known already to the market, I would also like to believe that I think to a greater extent, this entire exercise has been probably rebalanced, has been carried out, I think, all along at this point of time. Not that I think everything is going to start fresh hereafter. So to a greater extent, market price may have already factored the possibility of rebalancing. Maybe to a certain extent, I think you could see the participation increasing for likes of IndusInd and HDFC Bank. And that's where we remain confident. Fundamentals have not changed. On the contrary, fundamentals look as reassuring as they were before. And on the top of it, I believe that I think the bank's ability to lend in the current environment has actually, I think, moved up very sharply. And that is where probably we could see better half year as far as I think the second half of the financial year goes for most of the corporate banks, given the kind of balance sheet size that they are.
Devin, hi, good morning. I wanted your thoughts on TCS. The numbers are expected to be lackluster, but do you think a lot of it is already in the price? And at any point, would you look to accumulate?
Yeah, good morning, Sonia. Yes, obviously, I think most of it, I think, is in price. I think in this entire last quarter, or even for that matter, all these 6 months, if you look at the performance of most of the IT counters, the front end IT companies, TCS, Infosys, HCL Tech included, I think more or less the muted order book position is already factored in. Having said that, I think their already signed order books are basically resulting in giving them the power to execute this particular business which they have already signed in. The question here is that whether the force of the new orders would be as same as it was before last year. That is the question. Maybe that is where I think one would like to hear the commentary from the management. Because on one side, if the world is moving in the area of computing, and at the same time, I think the tech like I think the AI, the ML, the AR, VR, on this particular front, I would think that Indian IT service companies would have relatively higher amount of business to corner eventually. Maybe a couple of quarters from now, I think when you see some amount of dust settled in the global market, I would like to believe that Indian IT companies would start receiving the normal order inflow, which they are currently, I think, not seeing the visibility. So current result season probably, I think, give that direction. In my viewpoint, if the price corrects to a sharper action, then possibility of, I think, buying emerging into the market would be there. So one would keep an eye on falling price to buy back into this particular stock in the portfolio.
Okay. All right. We'll just come back to you in a bit because we're going to talk about one auto stock now. Not so much about the business, but more to do with the incessant rains in several North Indian states that has resulted, unfortunately, in loss of life, loss of property, as well as disruption in transport and business. Now, one such company, GNA Axles, their headquarters is in Hoshiarpur in Punjab, which has been hit by severe floods over the last many days. In fact, reports suggest that since Wednesday of last week, there have been heavy rains in Hoshiarpur and nearly 150 rural roads and 10 bridges in total were damaged in Punjab due to the floods. Kulwin Sira, who is the executive director at GNA Axles, is joining us now to tell us how the situation is there. Kulwin, hope you, your family, your entire team is safe. The floods have been really unfortunate and a lot of destruction has happened so far. But tell us, particularly for your business, what has the impact been?
Good morning, Sonia. So far the situation in our area is okay. So no such problem or no such issue is there. Business has been running smooth. No issues from any transport or road connection or anything here in this region. I think the areas affected are towards the Himachal border, towards where Chandigarh, Himachal borders are there. Because that area is like Baddi, and some industry units are affected there. Their transportation has been affected. And near the Chapar-Chidi area, that's again near Chandigarh, that has been affected. And some areas near Patiala and towards Rajpura Highway, those have been affected. But our area where our plant is and our connectivity to all the ports from here, everything is smooth. We didn't get any issues so far, touch wood.
So you're saying that entire belt of where all the auto companies are present in the state of Punjab, that entire belt has not been affected in terms of either business, all the factories are still running, or has production been hit, not just for your company, but for the others as well?
Like I said, it's in the Baddi area, whatever units are there. Those could be auto parts or anything, those are affected. But those are not a very large scale, some are medium to small scale. So, and I think it's a temporary disruption and should be solved soon now, as per the progress going on.
Okay. Well, since, thankfully there's no impact to your business because of this, can you just give us an update before we let you go on how business is at the moment? I mean, FY23 ended on a very, very strong wicket. What is the expectation for FY24 and, what are you penciling in terms of both revenue growth as well as growth in order book?
So last year, as you know, the growth was exceptional because of many factors, raw material playing a larger role. This year, the growth is there, but not as much as expected as last year. And besides that, right now, this month, we are going to have the board meeting for this quarter. So you'll get the results for this 3 months as well.
All right. Hi, Kulwin. Good to know that you, your family, as well as your entire team is safe. So that's good to know. But, we'll talk more post your numbers. But just before we let you go, you're earlier guided for high single digits, I think 7 to 8% revenue growth with margins in the vicinity of around 14.5 to 15%. Do you hold on to both those two numbers? And also, if you could give us a sense about what is the capex plan that you've laid out for this year. I think it was 300 crores for the next 2 years. For this year, what will it be?
So that's right, Nigel. As you said, those figures we are going to maintain those this year. And capex, you're right, from 300 crores, around 100 surplus we have already invested, and it's going on that way.
Okay, all right. Kulwin, we'll leave it on that note. Thank you very much for joining in and really hope the situation stabilizes. The north has seen a lot of rain fury in the last couple of days. We do have to take a very quick break, but before that, let's tell you what's lined up over the next half hour of the show. Coming up next, we get Anuj in to give us his sense on the market and the trade setup today. After that, we bring you some of the top stock picks for the day from our technical experts. So stay tuned, lots of action coming up. Welcome back. Well, Asian markets have been largely holding up, so the expectation is maybe we start optimistic. Well, let's bring in Anuj and figure out how he is reading the tea leaves this morning. Anuj, happy Wednesday to you. Lots happening, inflation, numbers, earnings. But, what's the overall sense you're getting?
Yeah, I mean, I think the market's good. There's absolutely no problem with the market. Of course, all the casino stocks and all, they will be in focus. But on the market, I think we're ready for the next move. I just want to start with three large caps. And of course, starting with the biggest stock, which is Reliance. Now, yesterday I spoke about it. Now, this is very interesting because Reliance has broken through a very important level, which was the previous 52-week high and getting very close to lifetime high. Now, this is a bit of a parabolic move here, but it's looking quite interesting. I think the other two, which is HDFC Bank and Infosys, let's fire them also one by one. And within that, what you will see is Infosys. Yesterday, we spoke about the relative strength for Infosys. It's getting very close to fill this gap, which was created after that last quarter's howler. Can it get there? I think if it does, that will be a very interesting thing for the market. And of course, HDFC Bank, which impacted the market yesterday, but now gets to be a giant. And in the current form, HDFC Bank will be 60% of the bank nifty. So I think that's perhaps could be the stock that could take the market from here. These three stocks, in fact, the three biggest stocks in the market. Now, in terms of what I'm expecting, I think we are ready for the next move. We had a good close yesterday, traded above Monday's high through the day. As I said, Reliance has shown signs of taking leadership. Infosys and TCS, they have shown some signs of perhaps some kind of a near-term bottom. And the broader market, after 3 days of correction, the broader market had a good day yesterday. And my sense is, right at the open, the mid-cap index perhaps hits a fresh all-time high today itself. So that's good news. Event-heavy day in terms of macros and micros. You have the inflation data from the US, from India as well. And of course, you have the earnings season, which kicks off with TCS and HCL Tech. Now, coming to day's outlook, I think on the Nifty, because we traded all through the day above Monday's high, that makes Nifty technically very strong. The resistance zone for today is 19,515 to 19,540. That's the previous 2 days swing high. And above 19,540, I'm expecting a sharp move to 19,700. Now, HDFC is last day today, so there could be some volatility. But HDFC Bank's low today could be the low for a really long time. That's the sense I'm getting talking to people. On the Bank Nifty, which was a one shade weaker than the Nifty and closed below the 10-day exponential moving average after a long time, the next support is the 20-day exponential moving average, which is placed at 44,500 thereabout. But I would still give it benefit of doubt because of what's happening with the HDFC Bank merger. And let's see. Today there could be some volatility, so it's better to focus on Nifty than Bank Nifty. But overall, I think the large stocks are looking good, and I think the mid-cap market is looking very strong.
Okay, all right, Anuj, thanks a lot for that. Well, let's move on and let's get in Mitesh Thakkar as well as Sudarshan Sukhani, who join us on the show. Hi, Mitesh. Hi, Sudarshan. Good morning. Thanks so much for joining in. Well, yesterday we thought that 19,500 was there for the taking, but we were disappointed because we came off those highs. How do you approach the index from these levels? Sudarshan, you go first.
Okay. See, the Nifty is in a uptrend. That's the basic fact that we must understand. Now, within this uptrend, there will be days when markets will be choppy. There will be days when they will be subdued. That's irrelevant. The bigger picture is, what is the side on which we want to trade? And the answer is very clear. In an uptrend, we want to trade only on the long side of the market. So for today also, the trade is to buy on a small intraday dip. We are now, the Nifty is in a trading range for the last 6 days. It will break out whenever it does. I'm assuming it will break on the upside because the trend is up. So we need to be positioned for that eventual break on the upside by buying a dip and holding on to it. Our stops will be 19,250. Now the Bank Nifty is a different story. Anuj also spoke about it. The Bank Nifty has been falling consistently for 5 or 6 days. But there are many other reasons why that could be there could be a decline. I would think that that decline is a correction and a buying opportunity. So if the Bank Nifty starts crossing levels of 45,200, and here there is there's a condition. If it starts crossing that level, then go and buy the Bank Nifty also. You might actually end up buying at a low or a dip. So the Nifty is a buy on an intraday dip, and the Bank Nifty on a cross of a certain level.
All right. Mitesh Thakkar is also with us. Mitesh, good morning. HDFC Bank, Anuj was also pointing that out, has had a decent run. I mean, the leadership is in place as far as the stock is concerned. But you tell us on the Bank Nifty, on names like HDFC Bank, do you see further upsides? And what is your view on the headline index now?
Yeah. Good morning. So on the bank nifty, I think, if you go back a few weeks, the bank nifty was peaking out around the levels of 44,500, 44,450, and we are not very far away from there. 44,745 was the closing for the bank nifty yesterday. So under 250 points lower, we have a very strong support coming up. So I think in that sense, I would be looking to go long over here. HDFC Bank, of course, they've had a rally, and then last 2-3 days they've given a pullback. They're now at their 20-day average levels, so they could give a bounce back. So yes, from a trading point of view, I think everything looks appealing. But I'm not very sure that we are immediately resuming a big uptrend. So we could get a bounce back in the next 1-2 days. If you want to take a small trade with some about 1.5% kind of a target on the upside and 0.5% of stop loss, I think that may still work out. But I would still want to see the Nifty get past 19,550 to go aggressively long. Till then, we are trading with clearly more of long bias, but not very aggressive because we want to see the earlier high being taken out. And once that happens, it will be more comforting.
Okay. Let's also get to the stock picks then. Let's start with you, Sudarshan. Good morning. What stocks would you go with today?
Good morning. See, primarily we need to be on the long side of the market. Apollo Hospitals is a buying opportunity. The stock has already rallied 25% from its April lows, but there is some momentum on the upside, so short-term traders can probably capture that momentum. Your stop is under 5,000 and look to buy it. Now, the only intraday short is Astral. Astral has been falling for the last 6-7 days, probably some fundamental or some other company-specific news, I assume. But in any case, there's a short-term trend on the downside. You can look at an intraday short with a stop above 1,810. Then we have BPCL, which has been almost at its new highs for the current rally. BPCL has been consolidating for 3-4 days. That's good enough for a new renewed uptrend. Buy with a stop under 380. And finally, Siemens is a buy. Siemens is a buy with a stop under 36.50. It's an investment buy. If you buy it, try to hold it for a long period.
Okay, got that. And Mitesh, morning to you as well. What about your stock list for the day?
Yeah, good morning. So I have a mix of buys and sells. On the buying side is Sun Pharma. Disclaimer, we have some positions here as well, so there's vested interest. But it made a fresh breakout yesterday. So I would buy this with a stop at 1,050 for targets of 1110 to begin with. A buy on IDFC First Bank with a stop at 81.5 for targets of 87. UPL is on the sell side. It was on the sell side earlier as well. It's been declining and yesterday was a gap down. So we'll take a fresh sell here with a stop at 656 for targets of 620. And the final sell call is on Naveen Fluorine, the stop at 43.50. Take a short position for targets of around 41.25.
All right, Mitesh, Sudarshan, thanks a lot for that. Well, we have less than 5 minutes to go before the pre-opening rates kick in. Devin Choksi is still with us and we're going to talk about several other stocks in focus. But before we let him go, Devin, just one final comment from your end on all of the defense stocks that have been running quite a bit. I mean, the government is, making a lot of progress in several areas in the defense space. And we've seen names like Masgao Dock rally substantially. But someone who's missed out on this rally entirely, is it too late or can you still enter? And if yes, which are the stocks you're looking at?
So I think many of the defense stocks, Sonia, have actually ran up ahead of time in anticipation of higher amount of business, of course. And fortunately, I think it is not only anticipation, but I think a calculation also at the same time, because the order books are known to many of these companies. So to a greater extent, I think it is a predictable execution, that is for sure. However, nothing else said and done, this is going to take time and these are not going to happen in 1 or 2 quarters. This is, I think, a long-term journey. At the same time, in defense business, governments, basically the buyers, obviously the margins are always going to be tight or squeezed. In such situation, the companies which are generating higher amount of surplus because of the inherent strength that they have, they would be the ones, I think, who should be looked at more carefully. I think most of these companies currently are having fair value price as far as I think their outlook is concerned in immediate term. I would probably, I think, wait before buying into it. So we like some of the companies which have been ancillary to defense, and some of them are the main supplier to defense. The likes of solar industry, which is a main supplier as an OEM to defense, or even for some of them, other companies like DCX Systems and among others are also having, I think, a defense portfolio as far as I think some products are concerned. So we selectively look at those companies, but not necessarily chase them at this point of time.
Okay, all right. Devin, final question before we let you go. What about Delta Corp? That's likely to be the stock of the day, right? It's possibly not something that the management would have been looking forward to. But GST being implied at around 28% on the chip sold itself. So if you go to play, you want to play for 100 rupees, you'll effectively have to pay 128 rupees. Even the winner actually will be in trouble because he'll have to win more to make some profits. How do you approach the stock? It's likely to get slammed in the start itself.
Yeah, I think it is possible that I think this is going to be a situation going forward. Maybe I think people will choose other destinations outside the country to play. Those who want to play, I think they'll definitely fly out and they'll play in the nearby destinations. That is what my guess would be.
Okay, all right. Deven, stay on. We'll come back to you in just a bit. Also have to take a very, very quick break. We'll come back. We'll have the pre-opening rates, of course. And we'll also talk about the story of the hour, really. We'll have Nitish Mittersain, founder and CEO at Nazara Tech, joining in to talk about the GST changes that were announced yesterday. Nazara, remember, as of now, is saying that it only impacts 5.2% of their FY23 revenue. More details with Nitish in just a bit.
Welcome back to the show. Well, IT heavyweights TCS and HCL Tech will be kicking off the earnings season today. Sumit Jain, the IT analyst at ICICI Securities, joins us now to talk more about that. Sumit, hi, good morning, and thanks for joining in. This is there are many firsts, right? I mean, this is the first time that HCL Tech is reporting before Infosys. This is the first time that at TCS you have Mr. Kriti Vasan also on board, and this is the first results post his joining in. So lots to talk about. Tell us, what are the top 2 or 3 things that you're watching out for? And in general, how are you approaching the IT pack?
Yeah, good morning, Sonia, and good morning to your entire team. So I guess clearly, I mean, going into the quarter, I guess the quarter is pretty weak as per the demand commentary from all the company managements. And I guess what we would be keen to watch for is the order book, first of all, because I guess there is a clear focus on cost optimization deals by almost all the companies, particularly the larger ones. And I guess that will give them a slightly longer visibility of the revenue growth going forward. And I think that given that the smaller deals are shrinking, if you look at the Accenture commentary, clearly I think that will create headwinds in terms of order book conversion to revenues in the near term. So this is where I think we are more positive on the larger companies like Infosys and TCS going into the result season and over the next 2 to 3 quarters, given that there are a lot of headwinds for the sector in the near to medium term, not just because of macro slowing down, particularly in the US geography, where, retail, high-tech, telecom, and banking, which contributes to almost 70 to 80% of the revenues for these companies, is slowing down. So I guess in the current environment, clearly you have to focus on those companies which can stitch large deals on the back of their capabilities, and that will provide them the growth visibility for next 2 to 3 quarters. And then you also have to look at the valuations for the sector. I mean, Nifty IT right now is trading at around 21 times 1 year forward, which is still at a 10-15% premium to the broader market, whereas the earning growth for the Nifty IT and the broader IT sector is still, mid to high single digits this year compared to broader Nifty at mid-teens. So I think from the valuation perspective, it is still not very attractive, and there could be further correction if the next 2 quarters are going to be weak, which seems to be the case based on the recent Accenture commentary, as well as the commentary from all the Indian IT companies. So yeah, I think what we will be keen to watch will be the order book by these companies, any signs of demand improvement, and also the impact of generative AI on the broader industry. I mean, we are seeing news from almost every IT company trying to train as many employees on these tools. Wipro just came out today morning saying that they will invest $1 billion in it over the next 2 to 3 years. Accenture in the last earnings call said that they have already received $100 million revenues in the last 3 months, and they're planning to invest $3 billion. So I guess the partnership with the hyperscalers out here in terms of particularly Microsoft Azure, AWS, and Google Cloud will be very critical, and how companies will be evolving their generative AI solution. So my only fear is the generative AI should not have an initial negative impact on the industry the way we saw for cloud and SaaS back in 2015 to 17 period.
All right. Hi, Sumit. Good morning. Nigel on this side. Sumit, I wanted to ask you about HCL Tech in particular, because there's a lot of pre-positioning that's taken place out there. In the last 4-5 sessions, the stock is down 7-8%. I mean, could that be an additional negative that sees the stock getting a further knock from here? And I ask this because I think it's one of the fastest growing IT companies. Also, it has some kind of valuation comfort. So how would you approach the stock from here on, and what could be the key numbers we should work with for HCL Tech, according to your estimates?
Yeah, I think in case of HCL, we believe that they might cut the top end of their guidance this time around. So we are expecting a flattish growth for them this quarter in terms of QOQ growth in CC terms. And their ER&D business will actually face quite a lot of headwind because the projects cancelled last quarter haven't revived as per the company management this quarter as well. So I think, and I think the street is building in a higher estimate for them. So there could be a bit of a disappointment. But yes, even despite the cut in the top end of the guidance, we are expecting them to probably guide for a 6 to 7% kind of a growth for this year, which will still imply they will be the fastest growing company this financial year. And this is where, if you look at our target price, almost close to 1,200, we have almost 8 to 10% upside on the name, and we have an ad rating. I think the only problem in case of HCL is the consistent improvement in ROE and ROCE we have not seen for last several years. But yeah, I think there is a clear scope for a bit of a re-rating for them, given that they will be the fastest growing company this year.
Okay, all right, Sumit, thanks so much for stopping by and giving us your views, on what to expect from the IT companies, as well as a couple of them that will come out today itself. But let's focus on, the GST Council meeting. The 50th meeting of the GST Council, well, it concluded yesterday. And the panel said that online gaming, horse racing and casinos will attract 28%. This will be levied on the full value of the funds that gaming companies charge their customers. The tax will take effect after the amendments are made to the GST law. Mr. Nitesh Mittersen, the founder and CEO at Nazara Tech, joins us on the show. Hi, Nitesh, thanks so much for joining in, and good to have you on the show. Well, I've looked at the clarification you've given, and real money, well, gaming, that forms only around 5% of your revenues. So safe to assume that the remaining 95% of your business doesn't get impacted at all. But you also mentioned that there will be various M&A possibilities in this segment. That's real gaming. Will that be shelved now, or will you go ahead?
Sure. So to start with, it's important to understand that Nazara is a very well diversified gaming platform. We operate in multiple segments of gaming across multiple geographies and across multiple business models. So to that extent, the impact of this particular announcement potentially on our, skill-based real money gaming business, which is limited to 5% of our revenues in FY23, will be minimal. And that is what we have clarified already. Of course, Nazara has been, acquisitive in nature. We always interested in partnering with great companies, founders and management teams in the gaming space. And we continue to pursue these opportunities across all the categories and segments that we are operating quite aggressively. This includes the skill-based RMG space. But of course, with this development, which has just happened yesterday, we will, of course, have to see how this plays out, the relevant impact to the industry and our own strategy there. It's all work in progress at this point of time.
So you'll not be pulling back on your plans? I mean, you'll have to alter those plans, right? Because now the viability of the business itself is taken ahead.
Our M&A plans do not get impacted across the various segments that we're operating. Like I said, this particular segment of RMG, we will, of course, have to review our plans
on RMG. Got it.
So just to clarify, Nitesh, even on the other aspect, I mean, your other segment, esports, which forms the bulk of your revenue, or even Kidopia, esports, or some of the other games there, where at the end, the player does get a reward of sorts, and sometimes that can be a monetary reward. Now, I don't know how many of your games have that model at play, and could could there be an interpretation issue over there? Because if there is any online game where there is a monetary reward towards the end, then perhaps it could come under this 28% ambit?
No, I think the difference really here is that this particular taxation is linked to the amount that the players are wagering or betting on the skill-based real money games, which does not have sports. There is no entry fee charged, and therefore that would not be. This would not be relevant in that case.
No, but just to clarify this, the whole outcome of the meeting yesterday, Nitish, was that the GST Council is making no distinction between game of skill and game of chance. I know this was a matter of litigation in the courts, I think in the Karnataka High Court, if I'm not mistaken, but at the council level, all online gaming is being treated equally and is to be taxed at 28% if it's real money gaming, and there's no distinction whether it's game of skill or game of chance. So does that impact any other part of your business as well?
No, in our understanding, it does not.
Okay. So just to take Nigel's point forward, I mean, you said that you will have to review your future plans with respect to real money gaming. That was a big area, a big focus area that you were looking at. So I just want to ask you, I mean, of course, you'll go back to the drawing board and see sort of how things play out. But a lot of people are already questioning the viability of real money online gaming with the developments that took place yesterday. Where do you stand on the debate?
So I think, first of all, you will appreciate that it's very early. It's just happened yesterday. And we, as well as the industry, right, is reviewing what has come out. And there are very active associations such as AIGF and others, which will definitely, pursue how the risks of or the challenges posed by this can be mitigated. From a Nazara perspective, again, it is a bit early for us to, define a clear-cut strategy. Obviously, we will have to pause and review our RMG strategy. But if you will appreciate, Nazara has grown in the last many years across several categories of business very rapidly. And therefore, while RMG, of course, was a prospective area that we were getting quite interested in, you will also appreciate that since the time of our IPO, we have always said that we are waiting for regulatory clarity to take a larger move in this particular segment. So I think we do not have any limitation of growth opportunities. In fact, in the last year or so, we have very actively pursued many M&A opportunities because globally, due to market sentiments, we have seen many assets available at very attractive valuations. So we have a very strong pipeline of investments that we look to make even outside of RMG, and we will continue down that path very aggressively.
Okay, I just have one clarification. Players pay money to participate in the esports competitions, right, that you conduct. And when they do, they have to pay tax, right?
No, sorry, that's incorrect. In esports, players do not pay any participation fee.
Okay, so there's no participation fee in esports for the players. Got that. I want to understand what the industry would be doing according to you. Do you think the industry will challenge this going forward? And what do you see as the consequences of this? A lot of the smaller startups, etc., do you see them move abroad?
I think you will definitely see the industry try and challenge or, work on trying to find a solution here, because this really is going to be very painful for the industry. And I can see the associations getting very active and trying to get a consensus on what we can do here. So I think you will see that play out over the next few days. In terms of startups, of course, the younger startups, especially in the skill-based RMG space, are going to struggle a lot because raising any capital will become impossible for them and sustainability will become a challenge. So I think a lot of them will potentially also go out of business. And lastly, I think moving abroad may not really solve the problem. You still have to pay tax if you are, operating in to the Indian consumers. And unless you go underground, which is not a way any startup can really work. So I don't think that's really a solution for anybody.
Okay, so Nitish, just to wrap things up and to go back to the main clarification that you've issued today, the understanding is that for your esports segment, which is the bulk of your revenue, I think over 50%, you're saying since players don't have to pay any entry fee upfront, There is no question of taxation, and therefore this 28% doesn't apply. If you could just finally tell us that for all these other segments, what is the rate of tax that a player needs to pay? And once again, I ask you once again that how many of your games, or let's say, what part of your revenue segment involves a monetary reward, maybe towards the end of the game? I mean, right now, the whole thesis is on the upfront money a player is paying on chips, etc. But I'm just trying to understand, in how many of your games is there a monetary reward involved at some stage of the game, maybe at the end, at the winning stage? We just need to keep that in mind, given that taxation is a sort of a moving piece here.
Look, one of our main segments of revenue generation is through the gamified learning space with our popular apps such as Kidopia and Animal Jam. And these, because they tend to younger kids, do not obviously have any inputs or outputs of winnings or money related to winnings. So I think that segment itself has it contributes to about 30% of our overall revenues.
Mm-hmm.
Even in the segment, we are only tournament organizers. The games are not even ours in most cases, and within the game there is no payouts that happen. These are tournament prizes that are paid out, and like I said, the teams that participate also do not pay for participation. So that clearly also comes under this ambit of this current law.
Okay, well, thank you for all of those clarifications. Appreciate it. The stock was under a lot of pressure. In fact, even this morning, the stock is down almost 13% in pre-opening. So let's see how that shapes up. But for now, the market opening is upon us and looks like it's going to be a good opening. 60 points higher for the Nifty. The Sensex is up about 140 points. And big moves coming into certain names in the FMCG space. ITC, Titan, HUL are all doing well. Nazara Tech, by the way, could be the stock of the day on the downside. So that one is down almost about 13%. Remember, there's been large buying from FIs as well. Almost 11,000 crores has come through in the month of July so far. So it's been pretty impressive, actually. And that's what's kept the market afloat in the last many days. And we've had some solid cues coming from our global peers as well. So all of that perhaps will take the markets higher this morning. Well, there's the first take on the Nifty, hanging on to 19,500, up about 50 points on the index. Good opening for the Sensex as well, 170 points higher for the Sensex, while the mid-cap index is up about 115 odd points. What's leading from the front this morning is ITC, up about 0.8%, followed by ONGC, JSW Steel and Titan. Banks are actually doing well. The Bank Nifty is up about 120 points. Kotak Mahindra Bank, ICICI Bank are in the green. HUL, Sun Pharma and Axis Bank are also holding up quite well. On the downside, though, you have something like M&M that's just coming in for a bit of profit taking. Remember, it's had a really smooth run. Last 1 year, it's up, since the start of the year, it's up 25%. And then Maruti Suzuki, HCL Tech. In fact, HCL Tech ahead of its numbers is a bit sluggish, so do keep an eye out on that. TCS as well is not doing too much ahead of its numbers, just flat at the moment. And Bharti Airtel is just a tad bit in the red. Suffice to say, it's a good start to the market. The Nifty is up about 50 odd points. The advanced decline ratio is solid. So, that's what's, the market breadth is looking very good at the moment. Let's see if we can build on to that.
Well, that's right. But the stock of the morning has to be these online gaming companies. Nazara Tech, as we pointed out, they said that it's limited to just 5%. The impact of this GST at 28% is impacting only 5% of their business. But they had plans to expand in this particular vertical, which will now get hampered. Stock is down closer on 7.5% kickstart trade. Delta Corp, that one's locked in lower circuit, down closer around 10% odd. The viability of the business itself is being challenged. We'll have to wait for the management clarification, if any at all. But for the time being, with what we have on the table, it's a clear negative to them. And probably one of the worst case outcomes that could have been expected have come out. This is as of now. We'll have to see how they move around with things. For the time being, it's down closer around 10%. Pidilite as well, you had a brokerage note that was a little bit cautious on their high valuations. Well, that stock's down closer around 3% odd. On the flip side, PWare, Inox, they are happy. The GST, they were expecting to be maintained at around 5%. So not getting into any regulatory tussles and the like. Good news for them. It's up closer around 3%. A couple of other names that are moving well. Lupin, in the final few minutes of trade, you had a bit of a booster shot coming in for their Pitam per unit. That's opened with a gain of closer around 2%. And Ashok Leyland as well. The stock is up closer around 1.5%. When you look at the headline index, yet again, we almost went to around 19,500, almost kissed that mark. But it seems that the bears are coming in to defend that 19,500, 19,525. as we've seen in the last few sessions. So, what else?
Well, you said it, Nigel. I'm also watching out for exactly that. The fact that we started, with some momentum, but already there's more caution than momentum right now on the screen. Reliance is flip-flopping around the red line. They're selling in pharma early on in the morning. Divi's is down, Cipla, Dr. Reddy's, the stock's under pressure. Tech is very soft as we begin the day. Infosys is down about 0.3%. And banks are okay, but IndusInd is the one that's down about 1.5%. Just some more names on the mid-cap screen because mid-caps are relatively sort of outperforming. So there's a Shoka Buildcon, there's some gains there. Varun Beverages is trying to, knock up some gains. HOEC is up about 3% odd. Tatva Chintan, which is looking to raise some funds, about 2.5% up there as well. But otherwise, it is fairly quiet in the mid-cap market. Mazgaon Dock, this stock I think is in a different orbit. It lives on an alternate planet. In a market that's slightly dullish as we start the day, Mazgaon is up 5%. Yesterday's mover, Kalyan Jewellers. Ever since Kalyan came out with their quarterly update saying that India jewelry business has grown 34%, the market just can't get enough of it. At least this one. And there's a downgrade, by the way, on Titan. Double downgrades on Titan. Seems people are shifting some of that money to Kalyan.
And I just want to point out one more pocket that's doing really well over the last many days is tires. And today, the day belongs to CEAT, up almost about 3% right now. And it's been a gain of 55% this year for CEAT. Now, not only have the earnings picked up in terms of revenue growth, but the raw material basket has come off significantly. So that's aiding the margins. We saw it in the Q4 performance for CEAT as well and a couple of other tire stocks. And looks like even Q1 is expected to be quite solid for them. But let's pose all of these questions to Mahesh Patil, the CIO at Aditya Birla Sun Life AMC, who joins us now as a market master for the day. Thanks a lot for joining in, Mahesh. Appreciate your thoughts here on CNBC TV18. Do you think this is a market that has played out in terms of the upside, or is there a lot more to go? And how are you approaching it now, sector-wise?
Yeah, good morning. So, recent rally, what we have seen in the market has probably meant that the markets are looking a bit toppish from a near-term perspective. But really, if you drill down and look at fundamentally, the markets have actually gone on the back of fairly decent earnings growth, what we have seen, last year as well as forecasted for this year. So overall, on the valuation front, if you look at for the Nifty earnings, then Nifty is probably a tad higher than the long-term average. It's not as expensive as probably it was, say, 1.5 years back when the markets peaked out earlier. And even the outlook going forward, if you look at both our, GDP growth numbers have been upgraded than what we were looking at, say, around 3 to 6 months back. And even corporate earnings growth also looks to be fairly strong and resilient. Even in FY24, we are looking at around 16% kind of a Nifty earnings growth, which is fairly strong. So I think while near term, because of the liquidity rally, what we have seen, strong FIF flows, markets have gone up quite sharply. Might be some consolidation. There could be some probably pullback also, depending on global cues. But I think markets looking at a medium term, I think should scale higher depending on the strong earnings growth. And again, it has been driven by across sectors, right? It's not like one or two sectors. If you see banking sector reporting fairly decent numbers, NBFC is also showing good numbers now because the margin pressure which is there will ease off from this quarter onwards. Sector like, say, FMCG, while the volume growth is still a tad lower, but margin improvement because of lower commodity prices should be good. Auto sector is seeing good numbers. Industrial capital good, real estate. It's across more broad-based. And that's the reason why I think it gives a lot of comfort in this rally.
Hi, Mahesh. Good morning. Thanks so much for joining in. Mahesh, what about the broader markets? The headline index could consolidate, maybe you see a couple of percentage point move either which direction. But the real party has been in the broader markets. Do you see some signs of frothiness out there? Or do you believe there is still plenty of scope out there after the big underperformance we saw in the previous few months or previous couple of years for the mid-cap and small-cap indices?
Yeah, so you're right. I think the broader market has been fairly strong, and there are two reasons for that. One is we've seen good inflows even in the mutual fund side. The last 6 months, if you look at the large amount of inflows have actually come in the mid-cap, small-cap or large and mid-cap funds. So clearly that has, compared to, say, the large-cap category. And even from the FI flows also recently, what we've seen is that, I mean, earlier a lot of FI money was coming in through the ETF route, but now the recent flows have been more India specific. And that has meant that we've seen money coming into the mid-cap space. And that has led to the kind of outperformance what we've seen in the last 3 months or so. So, but again, I think, I mean, you're right. I think especially the small cap segment had underperformed in the last 5 years. So I think it's doing some kind of a catch up over there. But I think from a near-term perspective, I think the valuations there are also fairly priced. I think some of the stocks have seen a lot of exuberance and probably could be still expensive. But I think if the earnings growth in these sectors, especially mid-cap and small cap, continues to be strong, I think then I think there is enough bottom-up opportunities which will be there. And since a lot of these mid-cap and small cap companies are more domestic focused, right? Are not necessarily dependent on global growth. I think that's where I think we are one is most positive on, and I think given that, I think from a say 3-year perspective, I think mid cap and small cap also look good even from these levels. Though I think seeing the recent rally, I think there could be some. If there is a volatility, in the global market, you might see some kind of a profit booking here in this small cap space.
Okay, small caps are really the headlines, aren't they? Mahesh, hi. Good morning. Surabhi here. We've all been tracking the numbers, right? Hefty inflows into small cap funds, and several funds are actually shutting lump sum investments as well. You know, yesterday we were talking with the fund managers at Tata AMC because they are one of the AMCs that have decided to stop taking lump sum flows. But you tell us, I mean, when you or some of your peer fund managers look at the small cap basket right now, given this gush of money that's coming in, so you have to deploy it, you're looking at the universe of stocks available. I mean, is it still a comfortable situation to be in? Are you still getting decent ideas at a reasonable price? Or is the going getting a little tough now in small caps?
That's why I think the small cap and the mid cap space, right? I mean, depending on the scale and size of the fund, I think, increasingly it's slightly tough because the liquidity in this segment is not as great, right? So while there are always pockets of opportunity which are there, because especially in the small cap sector, segment is as much wider. It's not necessarily 200 companies. Even if we can go down the market cap over there, and there are bottom up opportunities which one needs to scout for. But I think one needs to then look at beyond the normal coverage which one would have. But I would say that again, the good thing is that there are a lot of new companies also which are coming in either through the IPO markets, which are providing opportunities to deploy, and we are also seeing some kind of sell down, especially in the mid caps space by the private equity fund, which is providing liquidity in case one needs to build exposure in some of these names. So while it is a bit tough, I think, but I think if you're really looking around, hunting and going beyond the obvious companies, I think there are still pockets of opportunities there for the small cap, and that's an endeavor which we continue looking at for new ideas, for our portfolios.
Okay, for now, actually, the market, the Bank Nifty has slipped into the red. So, well, it doesn't look like, the market is in any mood to take the levels higher. Perhaps because there are so many cues to reckon with, there are IT earnings as well. In case any shocker comes from there, then the market, doesn't want to be positioned at the top. Well, in terms of individual stocks, just wanted to point out that even though the market is very flat, there are individual stocks sitting at fresh highs. Reliance is once again at a fresh high, so don't lose sight of that. 2780 on Reliance. Lupin, Sun Pharma are at fresh 52-week highs. Interglobe Aviation is flying high as well. Just had to say that. 35% higher this year. Mahesh, what do you do with, some of these leaders of the market? Reliance has been doing really well. Auto stocks, Tata Motors, Bajaj Auto have been hitting new highs. Do you continue to back the leaders, or now do you think the time has come to sort of take profits here?
Yeah, so it's a tough call because short-term rally, stocks might look fairly priced depending on near-term earnings, but I think we normally look at companies, the outlook is good, right? Because companies tend to surprise. I think in this market, what we've seen that initially we came in from a very slow growth. So expectations have been slightly lower, and few sectors, companies continue to outperform. While we've seen some kind of disappointments in the consumer discretionary side, so I think one has to really look at not just the valuations, while they are important, but also the outlook, because when we buy into a company, we are not really buying it for the next 1 year, but slightly longer period of time. So I think companies which are continuing to outperform, where the outlook is good, and probably some surprises which could come in, positive surprises, one is okay to, one would continue to hold on to it. Obviously, what we do is that in our portfolios, okay, if the stock does exceedingly well in the short term and our allocation there goes above particular, we take some gains over there, but we'll still continue to be there with the performing stocks. That's what is a we will take, because I think the market is likely to be, while we're seeing a rally across, it's still going to be a discerning market, right? Companies which disappoint in the quarterly, I think they will also see those companies getting knocked down. And where that positive surprise, market will probably reward them disproportionately on the upside. So one has to keep that in mind, okay, when we're looking at the price points.
The one space, actually two spaces, Mahesh, in the mid-cap market that have seen an incessant move, literally. One is obviously defense, and we all know what's happened to stock prices there. The smallest of companies to the largest of companies. And the other is this electronic manufacturing space. Where again the new list, look at Cyient, DLM even again today, or these smaller names like Keynes and Sirma, etc. What is your approach to these? Because I think fundamentally no one's disagreeing on the street about the opportunity, but it's a question of the kind of companies you want to back and at what price. So what's your view?
Yeah, so both these sectors, the defense and the EMS space, have, I mean, the narrative there is fairly good, outlook is good. And that's seen the reason why we've seen the stocks doing well. But I think sometimes the run of what we've seen in this sector is slightly unnerving over there, because while the outlook is good, I think very difficult to really predict beyond a couple of years in terms of how the numbers will pan out. So market is, I think, discounting too much over here into the future. And that brings some kind of a caution, okay, in some of the stocks in this sector. So we would be a bit cautious over here. I think some of the valuations there are much above than our comfort zone, and we would, we would not chase some of these stocks at these levels.
Mahesh briefly mentioned IT, but how would you approach the stocks from here on? The next 1 or 2 quarters, unlikely to see any kind of positive surprise. But do you think from, if you have a longer time horizon, maybe some of this bad news could be a good entry opportunity, or would you just stay away? Because recession is still in the offing in the United States. Maybe the second half of the year could be worse. Your view on these stocks?
Yeah, so the IT sector, if you look at it, has been the most talked about sector, right? I mean, a lot of information flow is over there, and markets tends to react even in slight upgrade or downgrade, okay, in terms of earnings outlook over there. I would guess that I think this quarter would be a quarter where you will see, the last leg of downgrades which could happen to this sector. I think it will factor in the whatever slowdown, okay, one is expecting because of the slowdown in the US. What has happened is that the US recession or the slowdown has also got pushed back a bit, right, by a couple of quarters, I would say. So in that scenario, I think you're right. I think there will not be immediate upside in the sector in terms of outlook, because unless we hit that bottom over there, market will still be skeptical. But I would say for most practical purpose, I think the concerns in the sector are now getting priced in. I think after this quarter, probably it will get fully priced in. And I think that could be a good time to really look at this sector. We have been underweight on the IT sector, but we think that's now time to really look at it more objectively and constructively and build exposure in this correction, because we believe that, again, in this IT sector also, I think you will see few companies, there will be a wide range in terms of growth. I mean, some companies will grow at around full year around 13-14%. Others will grow at in low single digits. So I think stock selection also will be important over here in this period. But I think the whole digital story and digital transformation, I think, is a still medium to long term story, and I think that will continue to drive decent earnings growth after this year of consolidation. So I think this period is a good time to build exposure in the IT sector. And all these companies are now giving good dividend yield also, right? Because there is strong cash flow. So that also provides some margin of safety and cushion on the downside.
Okay, all right, Mahesh. We'll leave it on that note. Thank you very much for joining in. Appreciate you being with us. and giving us your views on the market. A market which, as Sonia also pointed out earlier, we've kind of sort of given up some of the day's gains. We slipped into the red for a little bit, but the buyers are not absent. They're announcing that, hey guys, we're still around, and the buyers have ensured that we get some green at least back on the screen for now. The next theme that we're going to focus on is, of course, all of this damage that we've seen in northern India. Incessant rainfall in several parts of the country, especially in the northern belt, have resulted in loss of life as well as property, as well as disruption in transport. Property estimated to be worth over 750 crore rupees may have been destroyed in Himachal Pradesh alone. Even areas near the Yamuna have been evacuated as water levels have been rising in the outskirts of Delhi. We now have with us Vinod Sharma, chairman of the FICCI Committee on Disaster Management, and I think we also have Mr. Lalit Agrawal joining in, the founder and MD of V-Mart Retail. Gentlemen, good morning. Thanks for joining in. I want to actually start by getting an estimation at an industry level, the industry body level. So, Mr. Sharma, if you could give us your sense on if you've been able to sort of compute any numbers or any rough estimates on the kind of business impact that this is happening, that this is having, production impact, production loss as well. So of course, I mean, it is a life of loss of life that's paramount on mind, but also trying to just get a sense of how badly businesses in the region have been hit.
No, you rightly said that natural disasters, they affect everything. They affect agriculture, they affect normal life, and floods and droughts are our common problem in the country. And every year, I think more than 2% of GDP we lose because of natural disasters. 3% we lose, in road accidents. But I think a very big loss every year we are having because of natural calamities. And this time, it is a record of 41 years. And we are seeing widespread rain in North India. I think the impact you are seeing, not only the number of people died, but industries are badly affected. And let me tell you that industry is affected because manpower, it need manpower, it need electricity, it need, infrastructure, and everything is affected. That's why the productivity is very, very less. And the most important, most crucial thing is the business continuity. The supply chain, which is broken because all these big industries, they are having so many ancillary units. And in case even one is affected, I remember that in 2010, 11, 12, when there was a flood in Thailand, we have seen the Japan automobile industry was badly affected. So same thing is in India. So FICCI has done, FICCI is having a committee. And not only committee, we are conducting programs, for the industry on chemical industrial disasters. And we are keeping all these important things in mind, particularly the vulnerability of the place. I think the India's vulnerability for natural disaster is known. We have vulnerability atlas. We should know that which area is more flood prone. 11.2% area is having riverine flood in this country. So I think the industries, we should be educated how much loss is there from this natural calamity.
Mr. Sharma, sir, sorry to come in over there. Your points are well taken. But I'm just trying to also understand whether right now there has been any estimation, I mean, any rough range where, what is the aggregate loss? Or even if you can tell us which are the specific industries. I mean, Himachal, for instance, we all know that it's a major hub for chemicals and pharmaceuticals. So at an industry level, at FICCI level, do you have any feedback coming in over the last couple of days in terms of which sectors have been more severely impacted, supply chains, and any estimation of the losses?
In fact, all sectors, and particularly automobile sector, because Haryana is also affected, Himachal is affected, UP is affected. So I think the supply chain is disturbed. We are calculating that how much loss is there. I cannot give you the rough estimate, but the 750 crore which we are talking about Himachal only, I think in case you see the complete North India, I think more than 200 crore or 300 crore, loss. I'm not calculating the productivity, how much productive loss will be there, but I think in case roughly we calculate the figures are coming that all these states are affected very badly, and the real figures will be coming soon.
Okay, all right. Thanks for those inputs, Mr. Sharma. Request you to just stay with us. We are also welcoming Mr. Lalit Agarwal, the founder and MD of V-Mart Retail, who joins us on the show. Good morning, Mr. Agarwal, and hope your team, your family, all of you all are safe, because you all are in North India. I'm not sure which part, but you'll have exposure business-wise as well. So could you tell us if your operations have been affected by this floods, and if you could give us initial feedback on ground?
Good morning. We are particularly very safe and very fine. I think it is definitely affected a lot of people. It is a little abrupt and little intensity-wise, little higher amount of rainfall which has come in for a particular time. But it was also a weekend, which is almost higher peak sales for a retailer. But yeah, I think it was not that bad in Gurgaon and Delhi. It was bad, but it was not that bad. But yeah, it did affect a lot in Himachal and Punjab and Chandigarh and even Jammu and Kashmir. So I think in these areas, it is definitely affected the livelihood of people. It is also affecting their crops.
Mr. Agarwal, yeah, right. Mr. Agarwal, from your business perspective, what kind of impact has it had?
I think we saw the footfall getting dropped. Definitely, the business is on those days when the monsoon is at its peak. It definitely affects the footfalls, and it affects the sale. But this time, the impact is going to continue, and it has continued even after the rains have stopped. But yeah, so the impact is continued till now, and we see the impact also futuristically going and continuing for next 15 to 20 days. So that's what we are expecting, and I think there will be some impact. There will be definitely both because largely our customers are mass customers who are dependent on farm income as well as their regular. Day employment is also very important. So I think there is an effect on people's livelihood, and their convenience, their mobility, all are getting affected.
Oh, absolutely. And it's so unfortunate, right? Day after day, we see stories about how people are getting affected in a big way across the board. But Mr. Agarwal, just wanted to, take Nigel's point forward and drill it down. Can you share any specifics with us in terms of numbers? Can you quantify for us what the impact has been? Any damage to your stores or your inventories in the affected areas? And any kind of losses that you've had to incur, and are those losses covered in any way?
So yeah, we are fully insured and we are all covered. But anyway, we have kept all our safety intact. So we have not incurred any loss, and there is no loss to our property or our fixed assets or our inventory. But yeah, definitely it's a loss on sales, and we have seen almost a drop of almost 70% of footfalls and the sales on the weekends, and then that's how badly it gets impacted. And even in the continuing week, we are seeing almost a 40% drop in the sales in those particular regions and those particular geographies.
Okay, so that is pretty grave, right? A 40% and 70% drop in footfalls, but I guess that would be expected. What do you think the impact would be on the supply chain situation for the industry, not just for you? And what are the other damages, the ramifications that this would have on business in general for the industry, apart from, a drop in footfalls?
Definitely it has disturbed 2, 3, 4 days of operations in certain parts, but in other parts it has impacted maybe a 1 week or a 10-day supply chain processes. And then definitely even our trucks are not reaching the stores, and they are stuck in the middle, and they can't reach the store. So there is definitely a problem in the overall logistic area and then the road transportation. And I think even the labors are not getting reported in the factories, because we've got a lot of suppliers also in these areas who are right now not able to fulfill or send the inventory also, because the labors are also not reported back into the factories and the warehouses. So there is definitely some disturbance which is happening. And the labors also, most of the labors come from villages, and they are going back to the villages. They want to check out their families. So some of those pieces are also happening. But I think it should get repaired within next week or fortnight. That's what I expect.
Okay. I guess if there's one thing we Indians know very well, it's resilience. We always bounce back, and I'm very sure that even from this crisis, we will. And our thoughts and prayers with everybody in northern India. So, gentlemen, let's sort of end on a slightly different note. Mr. Agarwal, can you give us a sense of the business X of this event? This obviously has been a very difficult one. It will take perhaps I'm not sure, actually, you tell us, will it, once the rain situation abates, are you expecting normalcy? I mean, instantly, because you're saying your inventory hasn't been impacted, your stores haven't been impacted. So if the bounce back is very quick, then what is your outlook for the full year? What is the kind of growth in business that you anticipate, irrespective of the situation?
I mean, we definitely have reported our numbers on the top line in this quarter, where we are seeing 12 to 13% of growth coming in, and we expect that to go up, because we are expecting more customers, because the second quarter normally is a weak quarter, but the third quarter onwards we see the onset of festivals, as well as the onset of the winter season, and maybe because of the huge rain, the winter season will get a little more preponed. The summer season will end up a little early, so there could be a little difficulty in forecasting what will sell and how will you sell those. Are you able to manage those seasonal requirements? So some of those pieces will happen, but largely we believe the growth is supposed to come in the third quarter largely, and then that's what we are expecting. And this time, because if the rains are good, farm income is going to be good, and that's how the people will have more money in their pocket to spend. And then
okay, all right. Well, hopefully things should improve, right? I mean, the damage has been quite disturbing up until now. And as you said, it's impacted retail in a big way. So hopefully things will get better. Mr. Sharma and Mr. Agarwal, thank you so much for joining us. Appreciate your thoughts. Let's step into a quick break. The market is still quiet, not too much happening. So we will put focus on the FMCG segment in our special segment, Quarter Se Quarter Tak. And to discuss more on this, we will connect with Abneesh Roy, the Executive Director at Nuvama Institutional Equities. Later, we'll be joined by Nitin Sood, the CFO of PVR Inox.
Welcome back. Well, it is time for our special segment, Quarter Se Quarter Tak. Today, we are talking about the FMCG space, and Manglam is standing by to take us through all of the expectations. Manglam.
Well, so let's set the stage then by presenting the overall expectations for the FMCG sector in Q1 FY24. We anticipate the return of volume growth. That will be the headline this time around, with mid-single digits volume growth projected for the entire industry. As the demand environment gradually recovers, we foresee a favorable scenario with regards to demand. Furthermore, the cooling off of inflation is expected to aid gross margins. Interestingly, companies are reinvesting their gross margin savings into advertising expenditures and price cuts to spur demand as well. Although summer products were impacted by unseasonal rains and moderate summer in the northern part of the country, the healthcare portfolio did see a massive, impressive growth as well on a favorable base and coming off the heavy COVID-related impacts as well. But shining the brightest in the FMCG landscape is the jewelry segment. We've seen 21% growth come for Titan and 34% for Kalyan as well. These companies hold a high hopes of recovery in the second half of this fiscal year post the monsoons. However, El Nino could be a bit of a risk. So let's talk about the updates that we've got so far for the first quarter. In the FMCG pack, we'll have D-Mart, which is about 18% revenue growth. Along with that, we've had Godrej Consumer as well, witness an expansion of their gross margins by about 800 to 1,000 points. Also, Marico, on the other hand, experienced a decline in their consolidated revenue, but their net profit has grown in double digits, whereas Dabur boasted a consolidated revenue growth of over 10%, but out there as well, net profit has been impacted. Titan, well, recorded a 21% jewelry growth in their jewelry business, whereas Kalyan as well, a prominent player in the Indian market, achieved an impressive growth of 34% in the Indian business itself. Now, in terms of what is expected in terms of margin expansion, for that you have to see how the raw material prices have declined as well. Palm oil has seen a 43% decline, palm fatty acid around 44%, copra itself has seen a 5% decline, Brent and Mentha, important marks, have seen a decline anywhere between 6 to 30% over last year. So as a result of which, we will see margin expansion for all the FMCG companies. What is it that the street is expecting in terms of revenue and EBITDA expansion from all the FMCG companies? Let's look at the next list, which comes in. What we're expecting in terms of growth for HUL, 8 to 9%, Britannia 10 to 12%, Asian Paints 6 to 8%. All these companies are likely to post their EBITDA growth higher than their revenue growth itself. 18 to 20% is the EBITDA growth that we're expecting expecting for Asian Paints. Look at the other set of the companies as well that we have. We have Tata Consumer likely to show extremely strong revenue growth. We have, some other companies. Nestle is likely to lead the pack with an impressive growth of over 15 to 16% in the company's revenue, and we will see growth in Nestle's EBITDA as well. Going forward, let's keep an eye out on a bunch of other things that we'll be watching out for. For ITC in particular, we anticipate cigarette volume growth ranging anywhere between 9 to 10 odd %, and the street would eagerly await their commentary on the business structure of the company, as it holds significant implications for their future endeavors as well. Also, in terms of outperformers, don't lose sight of the smaller players, Bajaj Consumer and Jyoti Lab. For the last couple of quarters, they've been doing extremely well. And in terms of impact coming in from the summer products business, watch out for Imami as well as, Varun Beverages, because they may see a bit of a demand decline on account of, the unseasonal rains that we saw. Let's watch out for valuations then for the FMCG pack. They've never been cheap, and now they've not been cheaper either. In fact, ITC is trading above historic valuations, as is HUL, Nestle, and Godrej Consumer. And a lot of the stocks are trading at fresh record highs, so that implies fresh record valuations as well.
All right, thanks a lot for that. Well, Avnish Roy, the Executive Director at Nuvama Institutional Equities, joins us now to talk about what to expect. In fact, they have released a note where they talk about how their coverage universe revenues will grow just 5% in Q4 of this quarter, compared to 9.5% that their coverage universe has grown in Q4 of FY23. So there's definitely a slowdown on the top line. Avnish, tell us a little bit about that. What are the key expectations this time around, both on the revenue front as well as margins? And where do you see the outperformance coming from in terms of individual stocks?
Sure, thanks. Firstly, on your question of the slowdown, I don't think it's a slowdown. See, revenue growth this time is looking optically more than the Q4 YOY growth because of two reasons. In ITC's case, because of the agri base being very high, there will be almost 40-50% dip in the agri business for ITC on YOY basis. Wheat exports was allowed last year. Currently, it is not allowed. So that is impacting the overall sector because ITC is a behemoth. Second is there are price cuts in soaps, detergent. So those are obviously also now anniversarizing. But if you see in terms of a volume growth, clearly things are turning a bit more positive because of two reasons. One is on the rural side, if you see Nielsen data also, now no category seems to be kind of declining in the rural India, which was not the case in the first half last year, when a lot of categories were seeing -5 to -9% kind of volume in terms of the rural demand. So that's positive. Second, of course, is companies are also giving back to the customer in terms of grammage addition and promotion. So that's also helping in terms of volume growth. If I see category-wise, food companies clearly doing better. Biscuits and noodles, for example, we have been calling out that they are gaining from the unorganized competition because of very high inflation in the unorganized part, while you get a biscuit and a noodle at a 5 rupee, 7 rupee kind of a pricing. So that is clearly helping them. Apart from that, we are also seeing that rest of the segments also the healthy growth is coming back, partly because of base effect. Definitely health and immunity portfolio seeing good recovery. We expect almost 8 to 10%, 11% growth in this part of portfolio for Dabur and Imami. Yes, the only weakness will be essentially in terms of the cooling and all those summer-related portfolio in terms of cooling hair oil, talcum powder, beverages, ice creams. But those will be for a few companies only. Dabur, for example, in spite of weakness in this part of the beverage portfolio, we'll see a healthy double-digit kind of a sales growth because international also is doing really well. International business should do well for most of the companies, faster than the domestic growth.
Avnish, hi, morning. So, okay, let me make it really, really simple because the trends are going to be complex. I think even the quarterly updates have told us that Marico is, far more conservative and sounding a lot more somber on rural growth than, let's say, Dabur. So tell us this, in terms of the stocks under your coverage, which are the one or two which you think will post perhaps best-in-class earnings and where we may even see positive surprises?
Sure. So what is emerging here is wherever there has been a sharp deflation, for example, copra and edible oil, there has been a very sharp deflation. There is a regional competition which is coming back, and companies have also seen negative pricing which impacts the operating leverage. That's why Marico, Adani Wilmar kind of companies are seeing that challenge. In terms of companies which will outperform, clearly Godrej Consumer, Britannia, these are two companies which we expect strong numbers. Nestle also should be good. Dabur and HUL are kind of mid-tier, ITC also mid-tier, and Bajaj Consumer, as Mangalam also highlighted, that is one company in the small cap space which is really now finally coming back in terms of good double-digit EBITDA growth, good margin expansion, and good growth in the volumes also for Bajaj Consumer. So those would be the outperformers. In terms of underperformers, yes, Marico, Imami, and United Spirits, those will be in the lower tier in terms of various reasons, either because of deflation in their pricing in terms of the key products, or in terms of the summer demand, or United Spirits has sold off the part of the asset. But for United Spirits also, P&A should see almost 19 to 20% kind of a sales growth and almost 9 to 10% volume growth.
All right. And what about the recent hike that we saw in the Karnataka budget? What kind of impact will it have on United Spirits?
Sure. So it will have some impact. Essentially, what is happening is because of the freebies every state government is announcing in the run-up to elections and post they come to power. This is a key overhang which liquor industry will see this year, because now Madhya Pradesh, Chhattisgarh, Rajasthan will also be there. Coming back to Karnataka, the hike seems to be quite sharp, 20% in the spirits and 10% in the beer. But for United Spirits, we need to see on the BIO and BII what's happening, because that's imported, so that may or may not see too much of an impact. But on the overall industry, if I see for the domestic IMFL, there will be a negative volume impact because this is sharp pricing, and Karnataka government needs 52,000 crore for the subsidies which they have announced. And my sense is the other state elections also will see a similar kind of a strategy by the political party. So this remains an overhang. Going ahead, United Spirits margins will improve, gross and EBITDA margins gradually. But in Q1, you will see gross margins remaining under not much of a improvement, while other consumer companies are seeing good improvement in gross margins.
Also, in your report, you write how United Spirits has sort of underperformed in the last 4 years, if you look at it, right? Is it largely, do you think this underperformance is something that will continue over the next couple of years with its peers, or do you think at some point things could change?
No, things are changing under the new MD. Clearly, we are seeing a lot of proactive action, a lot of new brands, a lot of higher aggression on the activation part, much better branding. So that's on the positive side. When you see the reported numbers in our report, that's getting impacted because company has sold around 11% of its portfolio, which is the lower end. So that is just because of that. If you see in the core part of the business, United Spirits in the past few quarters is doing really well. P&A, we are seeing double-digit 20%, 25% of YOY growth. Of course, the base was impacted to an extent by COVID, and then in the base, PIO also was impacted. So those are helping. But overall, under the current MD, we are seeing definitely good recovery in terms of market share also versus a Pernod. There was initially Pernod in the last 3-4 years has done better, but now under the new leadership, it seems that United Spirits is getting back market share. Radico also doing well, but I would say that these 2-3 players are the ones who will really see the gains. But definitely this year, because of the tax hikes, there is a impact on pricing, and volumes will also be impacted whenever that sharp price hike happens.
Okay, all right. Abneesh, thanks a lot for joining in. Appreciate your thoughts. We'll continue this discussion on the entire consumption space. There's an update that has come in what seems to be a surprise for multiplexes. The GST Council has reduced the tax on food and beverages that is sold at cinema halls to 5% from 18%. This comes after the Multiplex Association of India sought a reduction in the tax amidst confusion fueled by reports of cinema halls getting notices over the GST they were charging. But now it seems that companies like PVR were never really charging 18%. It was always at 5%. So there may not be too much of a relief for them. But to discuss this and more, we're joined by Nitin Sood, the CFO of PVR Inox. Nitin, thanks a lot for joining in. Were you ever charging, under that 18% slab rate before this? And is there any impact because of what has been announced?
Yeah, so let me clarify. I think there seems to be confusion on the matter. The cinema industry, which is approximately 9,000 screens across the country, post-introduction of GST, were always charging a 5% GST rate, which was introduced when the concept of restaurant service was introduced, without availment of input tax credit. But over the last 12-18 months, I think several of our members had received notices from various parts of the country, from different jurisdictions, GST authorities, claiming that a higher rate of tax should be levied. And the industry had gone and made a representation to the council to clarify on this matter. And we're very happy that the government and the council has issued a clarification saying that sale of food and beverages in cinema halls will continue to be taxed at 5%.
Okay. All right. Hi, Nitin. Good morning. So, status quo. So good news from the PVR perspective. And, that's why I think the stock is seeing a bit of a relief. I just want to clarify on one point. When you book your tickets, depending on the price of ticket, either it attracts 12% or 18% GST. Now, if you book your snack as well with it, with your ticket, then the GST will be applied, will be 12 or 18%, is it? Or will it still be 5%? Is there some kind of a bifurcation?
No, it will continue to be 5%.
Okay.
You will pay tax on cinema tickets at the slab of 12 and 18%, and separately, and you will pay the tax of on F&B at 5%. What I think the GST Council has clarified is that if the consumer does not have an option to choose whether he has to buy F&B, and it is a composite supply, which means I think cinemas club and sell both of them compulsorily together, then whatever is the highest marginal rate will get applied. To the best of my knowledge, this practice is not followed by cinemas across the country. So this is a mere clarification that they've issued.
Oh, that's good news. That's good news then. Otherwise, when I'm booking my ticket, I rather not book my snack. Otherwise, I'll be paying 12 to 18% for a snack. Otherwise, when I go to the counter, it'll be 5%. So.
Don't you think it's more fun
just
when
to
you go to the
clarify,
counter
you can
and you
continue
can
to book your snack. It will continue to be taxed at 5%.
Only 5%.
Yeah, absolutely. That's good clarification that's coming in. Then Sonia is already, licking her lips. She's saying she's looking forward to her next visit to.
No, I never pre-book my snacks. I always go and I choose my snacks on the counter depending on
that camp. Yeah, I kind of like the whole idea of just heading to the counter and then sort of parsing through and then deciding what you want to have. But anyway, Nitin, since we're on the subject of F&B, you folks have also been trying to sort of push F&B even through some of the delivery apps. As in looking at home delivery of this. I wanted to ask you this even earlier, so glad we're having this conversation. What's the thought? Because these days, even if you open up, let's say, your Swiggy or Zomato, sometimes you get these options, or even if you go to the cinemas, you'll see that you can get a lot of these snacks at home even when you don't come to the cinema. So at a more fundamental thought level, what's the strategy over here? Are you really looking to increase the revenue, F&B revenue? Is it working out? What are your expectations over the next couple of months, if that indeed is the plan? And more importantly, will this be then taxed at 5% or some other rate? Because the consumption is not happening in the cinema.
Sure. So first of all, on the tax bit, I think everything that we sell in cinemas on F&B front will be taxed at 5%. The government had issued similar clarification, for various other similar services like home delivery, cloud kitchens, railways, airlines, etc. So everything that we sell in cinemas on F&B will be taxed at 5%. Our big focus on F&B is to, capitalize and increase the offering that we have in cinemas, including, we now have live kitchens in a lot of our cinemas. We understand our consumers, experience the best of food when they go for dine-in options outside. And we want to, ensure that we offer same quality of food and beverage in the cinemas. It's a 3.5 hour activity. People are stressed for time. So a lot of work is going on that front, including, take-home products, which you don't want to consume, but you want to take home. Home delivery is a very big aspect. We are working on creating niche products that you can order for home delivery, even when you're snacking at home, watching a TV show or something. So that's all work in progress. Cinema average F&B spent. Yeah.
Sorry. Carry on.
So cinema average F&B spend today is approximately 50 to 52% of average spending on a ticket by a consumer. And, there is no reason this number should not be higher. In Western countries, we've seen this ratio as high as 70, 75% as well. And that's the aim, that over the next few years, we increase, the overall F&B consumption at cinemas.
So at cinemas is fine, but now I'm trying to understand this as a percentage of revenue for you. Because you said there's a lot of work going on, even, at home consumption, why not have the same food experience even when you're watching a movie, say, at home? So what is the kind of investment, if any, that you'll have to put in additional, investment to grow the F&B part of the business? And then overall as a percentage of your revenue pie, now whether it is home consumption or consumption at cinema or take away from the cinema for home, whatever way you do it, what part of your revenue pie you think F&B can grow to, say, over the next year or so?
Yeah, currently that number is very small. At least I think we want 5 to 10% of the overall contribution to come from these add-ons, including home delivery, takeaway, and some of the new stuff that we are doing. So it's very early days for us, but we believe there's a big potential. The combined circuit, we sell about 16 to 17 crore tickets annually. We've got a very loyal base of consumers who comes back and they want to experience. There's a big opportunity to, sell this F&B outside of cinemas as well.
Okay, and I recently went to the theatres and I must say that, the food, the service, the quality, everything has picked up in a big way. And of course, the box office collections have picked up as well. And there's so many new movie releases. There's Mission Impossible Dead Reckoning that's coming soon. So everyone, I think, is waiting for that. But tell us, leave us with one number. How have the box office collections been so far in this quarter and what's the expectation?
Yeah, I think as you rightly said, things are progressively getting better. Last 3 quarters for cinema industry have been fairly low. I think the Hindi and Hollywood film industry was struggling last year. There were not enough film releases. Luckily, what we are seeing is Hollywood is bouncing back in a very strong way this year. The number of film releases has improved quite significantly, and there is a regular flow of content. That's shaping up. The regional film industry is doing really well. We had 2 big films, Carry On Jatta and Bappan Bihari in Marathi, which have again record-breaking collections, which means consumers are keen to come back as soon as they're good films. I think Hindi is continued to see some bit of gaps in releases. While Hindi films have done well, what we are still seeing is in the last quarter or so, you have a film and then you don't have anything for 2 to 3 weeks. I think as progressively we go down to the next quarter and, end of July, we are seeing that the film releases are becoming more closer to each other and the gaps are reducing. So hopefully, the box office should come back strongly in Q2 and Q3.
Okay, all right, Nitin, thanks so much for stopping by and giving us clarity on, the changes or no changes on the GST front and giving us a couple of ideas in terms of how we should book our snack as well. For the time being, though, we'll slip into a short break. Come back, Mitesh Thakkar will tell us how to approach the markets. Welcome back. Well, the markets are trading mildly in the green, but we have come off considerably from the highs that we saw earlier today. So that 19,500 odd mark still remains elusive for now. Mitesh Thakkar is back with us. Mitesh, how do you approach the index? Well, it's been a fairly decent morning session. How do you approach trade, as well as give us a couple of picks?
I think on the index, I'm still waiting for 19,530, 540 to take a fresh down. While we will remain overbought, I think getting past the earlier highs means that there are chances of momentum burst, and therefore once you get past 19,540, take away tight stops of about 25-50 points. We just got between the nifty levels of top. And about 19,540, expect 19,650 as the near-term target. So I think we will wait for the breakout happen. Otherwise, I think this could go just sideways. Therefore, you want to buy really support level, which is close to 93,250. On the stock side, I have one buy and one sell. Granules is something which I like on the buy side. I would recommend buying here. You can start at about levels of 308 and a target of around 326 on the upside. Okay. And on the sell side, it's Brokerage, which is the latest event today. So that's a sell to start at 4670 for targets of 45.
Okay, thanks a lot for that, Mitesh. Appreciate your thoughts. Let's go across to Vivek now. He's tracking IndusInd Bank this morning. Vivek, why are you looking at it?
Well, IndusInd Bank, last evening the company updated its latest shareholding pattern, and this is for the end of June 2023, the quarter ended June. Now, the foreign headroom available, as per the calculation, comes to around 13.5% at the end of the June quarter. That is, the headroom available for FPIs to go ahead and increase their stake. Now, at the end of the March quarter, the FPI headroom was 14.19%. Now, why are we looking at the foreign headroom as far as the IndusInd Bank shareholding is concerned? Was the fact that, if the company had a foreign headroom of 15% or above, there was a likelihood that the company could have entered into the MSCI Standard Index, and this was a low probability inclusion. However, what IIFL Alt Research says is that because of the fact that the foreign headroom now available is less than 15%, the likelihood of IndusInd Bank coming into the MSCI Standard Index at this point of time is negligible. Now, another important factor to consider as far as IndusInd is concerned is that the promoters themselves have actually indicated their intention to go ahead and increase their stake up to 26%. One thing to note is that in IndusInd Bank, the promoters are actually classified as FPIs. So in case they go ahead and increase their percentage stake up to 26%, then definitely the likelihood of the stock going into the MSCI Standard Index is negligible. So on the back of that, some pressure today, but this is something largely along expected lines.
Okay, thanks a lot, Vivek, for that. Well, Nazara and Delta Corp are also in focus. So, of course, we had a chance to, get some more details on Nazara. And since then, the stock has, it's still down about 5-6%. But let's get Mangalam on board to tell us more about that. Mangalam?
Well, what exactly has happened is that the GST Council has really hit out at a bunch of businesses. Casino, horse racing and online gaming are these businesses where they will now be taxed at a uniform rate at 28%. And the street was worried about that. In fact, for casinos, the problem is that the tax will be applicable on the face value of the chips purchased. And if that were to happen, then, the initial inhibition that people would have to spend 28% higher than the face value of chips that they wish to purchase would reduce their volumes. At the same time, for online gaming as well, there would be tax applicable on the full value of bets in case of online gaming. However, analysts believe that tax on the face value of chips purchased may impact chip sales volumes at entry itself for players like Delta, and tax on full value of bets placed in case of online gaming may treat the game of skill as at par with a game of chance, and that's not particularly good. And which is what we're seeing in terms of a decline for the prices of Delta Corp and Nazara. However, Nazara on its part has said that real money gaming accounts for just about 5% of its revenues, and their impact or the impact that they have because of this would be minimal on their overall business. The street believes that from a long-term standpoint, this could have some sort of impact which is structural in nature.
Okay, thanks a lot, Mangalam, for that. Let's slip into a quick break. On the other side of the break, our special segment, Indianomics, where Lata will get chatting with former Agricultural Prices Commission Chairman and now Professor at ICRIER, and Ashok Gulati, and Harish Damodaran, the Agriculture Editor at the Indian Express, about the state of India's farm output this year.